All right. Hello, everyone. Good afternoon. And my name is Miracle Naji, and I'm a senior investment analyst at HealthCap Africa. And I'm so excited to have everyone join us today for this awesome webinar where we are going to be discussing on a very crucial topic that I know has been on all of our minds. And we're super excited to learn more about the topic for today. And certainly the topic still remains how to invest into startups, right? And we have a lot that has been packaged to be delivered, and very impressively, we have somebody that is going to be handling this topic, that is an authority in the topic, and you'll be very glad that you joined the call. And that person is Dr. Ola Brown. So I'll just like to encourage each and every one of you, sit tight, buckle up your seatbelt. You are going to have an amazing ride, right? So while we're having this webinar in the first place, we plan to inform, to educate, and empower you to be able to take critical action. So I'll encourage all of you to bring out your pen, bring out your jotters, and take down notes. And obviously, as well, we are going to have opportunities for question and answer, where you are going to be asking Dr. Ola Brown herself questions, and she will definitely do justice to it. And then before I bring her up, I'll just like to quickly just give us an insight into the person that we have for today that is going to be taking us on this very amazing topic. That person is Dr. Ola Brown, and Dr. Ola Brown is at the helm of the HealthCap Africa as the founder and also the general partner. She's a seasoned professional as well, with over 15 years of hands-on experience that spans across healthcare operations and also venture capital based investments, right? And she has an impressive track record that speaks volumes. Prior to founding HealthCap Africa, she was also a co-manager in the Green Tree Fund that did amazingly well, doing an IRR of like 25% and a TVPI of 7x and DPI of 5x. And she's the person that we're having on this call today. So when she comes up, she'll definitely tell us a bit more about herself. So without any further ado, I would like to call up Dr. Ola Brown. Dr. Ola Brown, you have the floor. Thank you very much. Doctor, you may want to check your mic. I think you're muted.
Hi, everyone. Sorry about that. I've just unmuted. And thank you for joining. How to invest in startups. It sounds like a pretty simple topic, but time and time again, I meet professionals, high net worth individuals, people from family offices that really want to get into the startup investing space, but don't quite know how. So this webinar is going to sort of set the context as to why people invest in startups in the first place, and how to go about it. Whether you're a professional working as an executive, or you're a high net worth individual that perhaps is a business owner or a corporate CEO, or whether you're a family office looking to diversify your holdings into venture capital and technology. So thank you so much for joining. I'm just going to get up my slides and then we can begin. So I'm going to start with an overview about me and my work, and then I'll talk about the key features and characteristics of startups, and then really importantly, for people logging in from Africa, the role of startups in the economy, reasons why people invest in startups, sort of a rule of thumb for investing that you can adapt to your own purposes, as well as some closing thoughts on portfolio management. So my name is Dr. Ola Brown. I'm the founder and general partner of HealthCap. I started life as a medical doctor, so I hold an undergraduate degree in medicine and surgery. My master's is in finance and economic policy, and I'm currently doing a PhD in finance, which is focused on fintech and monetary policy and digital currencies and how that all relates to financial inclusion. 2 years ago, I also received an award from the president. So I'm a member of the Federal Republic, which is a national honor from Nigeria. So like I said, I started studying medicine, worked as a doctor in the UK, then went on to move to Nigeria to start Flying Doctors Nigeria, which was West Africa's first indigenous air ambulance service, which has served 40 out of 54 African countries and probably close to 150 cities around the world. The company does emergency medical transport, urgent medical care, as well as urgent medical equipment. My career in venture and in finance started in 2015-16 when I invested in a fund and subsequently started running the fund. And we invested in really interesting companies like Paystack, like Flutterwave, and as well as health techs like MDAS, which is a diagnostics startup. I've also advised quite a lot of individuals and corporates on healthcare infrastructure and finance in Africa. I lead healthcare as a business for the Nigerian Economic Summit Group. I lead healthcare I lead healthcare business and trade for the Nigerian American Chamber of Commerce. I'm also on the ESCO of Women in Finance, where I also lead their gender equality team. I've published a lot of policy papers and market reports, including Impact Investing in Healthcare Financing in Africa, the Health Tech Unicorns report. I co-wrote or co-authored a report on PPPs in Nigeria for healthcare, healthcare financing report. I published 5 books. My latest one is Journey to Series A, which you can download from either my Twitter or LinkedIn. I also have a library of video courses on economics and finance, focused on venture capital, banking regulation and banking, microeconomics, macroeconomics, as well as infrastructure finance. In terms of the VC world, the first fund that I raised did an IRR of 25%, a TVPI of 7x, and a DPI of 5x. So we also have a very, very strong track record in the venture space of returning capital to investors. It's great to be here and talk about a topic that I love very much, how to get more people invested in startups. So to set the context, what are startups? Startups are early stage companies with high growth potential, but also a high risk of failure. A startup is typically a young company in the early stages of development, typically characterized by its focus on innovative products, services, or business models to the marketplace. And because of the high growth potential, they usually tend to be software products, although I've put quite an atypical company, Tesla, in the pictures. So there are 4 key features of startups. Number 1, their growth potential. So startups have high growth aspirations and seek to rapidly expand their customer base, revenue, and market presence. And they pursue funding from venture capitalists to do so. There's a lot of risk and uncertainty around startups. So they face risks associated with market acceptance, competition, funding challenges, operational complexities, and they require a lot of experimentation and iteration to get things right. Now, one thing that, really sort of interests people about startups is their scalability. Startups typically have business models that are designed for scale. So they aim to leverage technology, automation, and processes to really quickly scale up their businesses at a much higher growth rate than you would get in a traditional business, and therefore capture a significant market share. Innovation. Startups are known for their focus on innovation. They bring new ideas, technologies, or solutions to the market that address a specific problem or meet demand in a novel or disruptive way. So think about Uber and think about how we used to get taxis before Uber. The process of getting a taxi was difficult. You either had to stand on the side of the road or call a taxi company that would never answer you, or have one taxi guy's name that might be off, or he might change his number. It was just a very unpleasant, unsophisticated, and high friction way of getting transportation from A to B. Uber simplified that process by turning that entire uncomfortable, high friction process into an app where you could access an entire marketplace of taxi drivers and taxis of a particular standard, who then you could rate after using the service. So they brought a new idea, new technology, and a solution that addressed a specific problem to the market, and they solved and met that demand in a really novel and disruptive way. So four key features of startups: growth potential, risk, scalability, and innovation. Role of startups in the economy. Right now in Nigeria and across Africa, a lot of countries are grappling with economic issues, and startups backed with the right types of investments can have astonishing impacts on the economy. Let's take America for example. Investments in venture capital only represent 0.1 to 0.2 of US GDP, yet they employ 11% of America's workforce. So venture-backed funds only take 0.1 to 0.2% of GDP, but employ 11% of the private workforce in the United States. They achieve a growth rate of 50% higher than the total private sector. In terms of employment growth, they have 8 times higher employment growth than the average private company. And in terms of revenue, 21% of US GDP today is produced by venture capital-backed startups. And venture capital-backed startups form 41%, that's almost half of the capitalization in the public markets. The impact of these small investments, startup investments, can have astonishing effects on the economy. And that's something that we'd like everybody to bear in mind as we continue conversations amongst ourselves as investors or prospective investors, and also with policymakers. 5 reasons why people invest in startups. Number 1, people want excess returns above the benchmark. Above benchmark returns are called alpha. So investments in startups can register superior performance returns above market benchmarks. So in investing, alpha refers to a measure of excess return generated by an investment or a portfolio relative to what everybody else is getting. And according to Cambridge Associates, which is a think tank and family office outsourcing company, between 1995 and 2020, venture capital registered annualized returns of 17.5, outperforming the S&P 500, which just did 10.9. And this emphasizes the fact that while investing in startups carries higher risk, it also can yield more significant returns for investors than almost any other asset class in the world. So people chasing alpha tend to incorporate startups into their portfolio. Access to innovation. So venture capital and angel investing provide access to cutting-edge technologies and innovative business models and emerging trends. So a lot of people invest for the alpha, they want the above benchmark returns, but they also want to understand the innovation that's going on in the world a lot better. Apple, Google, Amazon, and Tesla were all once venture-backed. And together, these companies have a market capitalization of over $6.8 trillion. That's more than the GDP of India and the UK combined. And they're responsible for much of the disruptive technology, many of the disruptive technologies that have changed the world. So people invest for alpha, but they also invest because they want to understand the world of innovation. And they want to bring some of that innovation into the companies where they serve as executives or into their own companies as entrepreneurs. Portfolio diversification. Whether we like it or not, every single person on this call has an investment portfolio. You have income, and what you do with that income is your portfolio, your investment portfolio. So some people get paid a salary and they keep it all in cash and spend it by the end of the month. So their portfolio would be described as a cash portfolio. They don't really do anything with their money and they keep most of it in cash or cash equivalents, maybe in a savings account. And that's really all they do. Some people say, they want something longer term. So they either invest in equities, for instance, public equities. Some people invest in real estate. A lot of people buy land. Some people buy gold. And all of these things constitute their investment portfolio. So a lot of people I've mentioned chasing alpha. I've mentioned access to innovation. A lot of people invest in startups as well because they want to diversify their portfolio. So investing in startups through VC and angel investing allows individuals to diversify their investment portfolio beyond traditional asset classes such as cash, stock, or bonds. And the interesting thing about VC investing and startup investing is they don't really have a straightforward correlation with traditional asset classes, meaning that sometimes when other asset classes like real estate and like bonds are underperforming, startups actually can provide some protection. So the idea of portfolio diversification is to make sure that you have something making money for you at every point in time. So when the real estate market is bad, your public equities or your investments on the stock exchange are making money. And when the stock exchange is bad, your investments in bonds are making money. And when your investments are in bonds are doing badly, then perhaps some of your direct investments are doing well. And startup investing, because of this low or negative correlation with traditional asset classes such as bonds, when traditional asset classes are underperforming, your startup portfolio or your VC portfolio may provide some protection, giving you diversification. And this really aligns with the efficient portfolio frontier, something that I'll be talking about later on in the presentation, which means really incorporating various different asset classes with different correlations, which allows an investor to construct a portfolio capable of weathering both recessions and periods of growth, which means you're putting different sorts of investments together. You're not putting all your eggs in one basket. You're putting different things and different investments together to really create a portfolio that is efficient. And you always have something within that portfolio that is growing and making money for you and perhaps your family. Hands-on involvement is another reason why people invest in startups. So startups, when you're invested in a big blue chip company, there's very rarely much hands-on involvement that you can give the executive team. However, venture capital investors and angel investors can engage actively with the companies that they invest in. They're often providing strategic advice, industry expertise, and mentorship to help the startup succeed. And this can be fulfilling for investors that enjoy actively participating in the growth and development of a company. A lot of career professionals have absolutely no intention of leaving their jobs. So if you work for a big company and you have a big salary, then a lot of people just don't want to leave that job, but they do have entrepreneurial energy and entrepreneurial skills, which they would want to express. And if you're a doctor working in a hospital, or you're a professor working in a university, then that might be what you want to spend most of your time doing. But the hands-on involvement with startups, with your angel investments, gives a fulfillment that your job just doesn't give, and gives variety. So some people really enjoy that mentorship, that guidance, sitting on the board of advisors, sitting on the board of directors, and really helping a company grow from scratch, getting to be entrepreneurial, getting to roll up their sleeves, very different from their day-to-day jobs. Other people are entrepreneurs, and they have entrepreneurial skills. They've started lots of businesses, and they have large angel investment portfolios where they work actively with their angel investments, bringing that entrepreneurial expertise and track record into their investments. A neurosurgeon or a cardiologist or a pediatrician has clinical skills, but they also have a lot of clinical knowledge and experience and management experience. They know other doctors, they know radiologists, they know nurses, they know talent that can work in startups. Bankers, for instance, somebody that's been in the banking industry for 10 to 15 years has excellent relationships with other bankers, with people, with treasurers, with technology experts, for instance. So these kind of people, these kind of executives often want to do something entrepreneurial without leaving their jobs. And angel investing and venture capital gives them insights and ability to express their entrepreneurial energy without necessarily leaving their jobs. So I've spoken about the reasons why people angel invest or invest in venture capital. Chasing alpha, above benchmark returns. People get bored of the sort of predictable returns sometimes of public equities and bonds and your savings account, and want to do something that holds the potential to return more. People want hands-on involvement. People want to understand the innovation space better than they do, and bring those innovations into their companies or into their executive roles. So these are some of the reasons why people invest in startups. Now, how to approach these investments, and this really comes to the meat of the presentation. And this is really a rule of thumb that people use as an initial starting point to think about their investments across various asset classes. Of course, depending on one's risk tolerance, the size of the portfolio, the expertise in a certain asset class, people divide their investments very differently. But the 30-30-30 rule is a good starting point to at least think about what you're investing in and how you divide your portfolio. So the 30-30-30 rule says 30% should be in stocks, 30% should be in bonds, and 30% should be in cash or cash equivalents. So stocks are anything that you can hold equity in. That means your public equity. It could mean sort of equity in a company. And, the 30-30-30 rule says that 30% should be in stocks. Then 30% should be in bonds or fixed income. So not necessarily bonds. It can be any form of fixed income. Not entirely risk-free, but, 30% should be in fixed income. And then 30% should be in cash or cash equivalents. So what are equities? Like I said in the last slide, equities can be public stocks. They can be direct investments, so large investments in a single private company. They can be investments in a VC or PE fund. Some VC funds invest in 150 companies. So, the larger VC funds or the sort of early stage funds can have 100, 150 companies, like I said, in their portfolio. Some VC funds can just have 8 in their portfolio. But investments in VC and PE funds mean that you're spreading your investment usually over a whole load of companies. Then you can do angel investing, which is usually investing directly a small amount, usually in a friends and family type round, into a company. And then, of course, real estate. You own equity in any real estate that you own. You own the equity in your house. You own the equity in a piece of land that you built. So any sorts of equities that you own in the real estate space, whether it's commercial or residential, will be classified as equity. Then in the fixed income space, you have things like sovereign bonds, which are like the bonds of Nigeria, for example, or the bonds of Japan, or American treasuries, or UK treasuries. And then you have corporate bonds. So a lot of companies also have corporate bonds. So I think Guarantee Trust Bank has a bond out right now. Sometimes they'll do Naira bonds. Sometimes they'll do foreign currency denominated bonds. Microsoft has a bond out right now. Of course, they always tend to have both debt and equity options. Berkshire Hathaway bonds, ExxonMobil bonds, Citibank bonds, and then convertible bonds as well under the fixed income space. And then cash. Cash can be money in your savings account. It can be a certificate of deposit. It could be cash equivalent in your domiciliary account. So all of these things are cash and cash equivalents. So remember, 30-30-30 is a good rule of thumb. You adjust it and personalize it to where your expertise lies and your risk tolerance. But it's a good way to start thinking about portfolio management and what your sort of equity, fixed income, and cash holdings are going to be. So comparing equity to fixed income, you find that in equity, there's higher risk. When you invest in a stock on the stock exchange, it can go up and down within minutes, and it can respond to all sorts of things. It can respond to bad news. It can respond to, a bad quarterly earnings call. It can respond to even just bad PR. So the risks of equity as a partial owner of the company, you're a shareholder, are higher than usually a bond, a high quality bond, I mean. The returns are usually higher as well. So the potential upside for investing in stocks is higher than a bond, because a bond, you kind of know what you're going to get out of a bond. At the point of buying the bond, you have a good idea about what the return on the bond is going to be. It has a face value, whereas your equity holdings do not. The advantages of cash equivalents over equity. So obviously, cash is cash. You have it, you can spend it at any time. It decreases in sort of actual purchasing power because of inflation, but you don't need a specific period of time before you can withdraw your cash if you keep your money in cash in a current account. Whereas equity, sometimes, the prices can reduce really drastically in a matter of days. That rarely happens with cash, although you do see it in the emerging markets. But generally speaking, equity is more volatile than holding cash. Generally speaking as well, you can get higher returns from equity than you can if you just have cash in your savings account or in your current account and you're not receiving a return on it. So how the 30-30-30 rule applies to high net worth individuals and professionals. Studies show that high net worth individuals and professionals, executives, invest more in equities than any other asset class. So how do they invest? They invest in equities on the stock exchanges. So they buy stocks in blue chip companies, but they also invest into startups. And how do they do that? Sometimes they write direct angel tickets into early stage companies directly themselves. That means that they have to do all the due diligence themselves. They have to research the company, research the market, get all the different documents together, kind of formulate their own info memos or investment memorandums, and really do all the heavy lifting of, after the investment, being the go-to person in terms of introductions, in terms of marketing strategy, in terms of fundraising, subsequent fundraising strategy, and making investments or making introductions for subsequent fundraising. So direct angel investing is something that executives and high net worth individuals do, but it's quite labor intensive in terms of being able to do background checks on the founders in order to check out the incorporation documents, check out the cap table and make sure the calculations on the cap table make sense. And then obviously understanding the market research around the product and analyzing that as well. And you might even need to build a financial model to understand the returns and the valuation. The second way that HNIs invest and executives invest in startups is joining an investor collective or syndicate. And we run one, it's called the Catalyst Fund, and that does the heavy lifting for the HNIs and professionals. So we do all of the due diligence, we do all of the sort of financial modeling, valuation, negotiation, etc. So all the angels do is really see a deal and decide whether they want to invest. So that's another option. The third option is actually becoming a limited partner in a formal VC fund. And that means that they invest a large amount of capital and they commit that capital to investing in a certain number of startups, which could be 10, could be 25, could be 45, and in the sort of earlier stage VCs, it could even be over 100. So these are the three ways that sort of HNIs and executives can invest in startups: direct investment, joining an investment collective or syndicate, or of course, becoming a limited partner in a fund. And the direct angel investing is probably the hardest work in terms of, the burden of due diligence and portfolio management. The investor collective still requires an amount of work because you've got to look through the investment memorandums, you've got to understand the business, and then you invest if you want to, but you don't invest in every deal. Whereas if you're an LP in a venture fund, then you commit a certain amount to a venture fund and they invest on your behalf and you get the information about the investments that have been made on your behalf in a certain sector or according to a certain thesis. So that's really the way that the 30-30-30 rule applies to high net worth individuals when it comes to angel investing and venture capital. But don't forget, of course, equities also include real estate. They also include public stocks. and even commodities. Family offices, however, are private wealth management organizations that provide support to individuals and families. So a family office would be set up by an individual, probably worth $20 to $30 million, who would like to be able to structure their investment and have a team that manages their private wealth on behalf of them and their family. And some family offices have been in operation for multiple generations, and I'm talking sort of 5, 6, or even more generations. Again, private equity kind of wins in terms of what they like to invest in, because they like that alpha, they like that access to innovation, and they like understanding working with startup founders and understanding them. And there's two ways that family offices generally invest. They become limited partners, stroke investors in venture capital funds, or they invest directly themselves. Or sometimes there's a hybrid approach where you see family offices investing in smaller venture funds. So they tend to invest in seed or pre-seed, and then that serves as a feeder. So when they get companies that they like, they can then invest larger amounts of money as Series A and Series B. But that takes away the burden of like sourcing these small deals and sort of diligencing these small deals, when really large family offices managing $500 million, $1 billion don't really have the ability to deploy 50, 100K, 200K checks. So they invest in smaller funds as a feeder to the larger deals that they want to do. So that's a more hybrid model, which is a mix of investing in venture capital funds and direct investment. So before I finish, I'd like to speak a bit about portfolio management, just to describe some, I think, 3 important concepts to remember as you're thinking about your portfolio and you're thinking about portfolio management, you're thinking about your investment strategy for the year, and you're thinking about what you should be considering in this environment. One is the efficient portfolio frontier. So the efficient frontier, which I sort of mentioned earlier, is a set of optimal portfolios or that offer the highest expected return for a defined level of risk, or the lowest risk given an expected return. And a key aspect of that theory is what we spoke about earlier, the theory of diversification, and talking about the fact that diversification helps reduce the risk associated with individual assets, i.e. not putting all your eggs in one basket, but having an efficient portfolio that gives a high return for the lowest risk available for that given and expected return across asset classes. So across public equities, across real estate, across fixed income, cash, whatever that basket of assets, or whatever is in that basket of assets, whatever constitutes that basket of assets. The second concept that I'd like to speak about before we close is capital asset pricing model. CAPM is, one of the sort of most fundamental concepts in portfolio management, and it's an investment analysis tool that helps investors understand how much expected return they can earn from an investment. And it does this by examining the expected return on the market versus the return on risk for investments, such as treasury bills from reliable countries, as well as the sensitivity to the market. And this is often referred to as beta. The last concept that I'd like to sort of touch on is the Sharpe ratio. And the Sharpe ratio is a tool that helps investors determine if an investment is good enough or good or not. And this accomplishes this by considering just 2 factors: how much the investment makes and how risky the investment is. So the Sharpe ratio conveys that idea, while conveys the idea that making money is important, but within defined sort of risk parameters. So it helps assess returns versus risk. So if you're thinking about portfolio management, I think the most important concepts to understand are understanding what your efficient portfolio frontier is, understanding the capital asset pricing model, and understanding the Sharpe ratio. So, what have I spoken about? How to invest in startups. Investing in startups is an effective way to diversify your portfolio as well as seek alpha above average, above benchmark returns. And this presentation has provided insights into the following things. First of all, we discussed understanding what a startup is. And then we spoke about why you should invest in startups and why people generally invest in startups. And then we spoke about the 30-30 rule for 30-30-30 rule for investing and what those asset classes available for investing in are. And then we spoke about investing in startups for individuals or professionals. We also spoke about investing in startups for high net worth and family offices. And that brings us to the end of my presentation. And I'd love to hear some questions about what you're thinking around portfolio management and strategies for investing in startups.
Wow, awesome. Great presentation. Thank you very much, Dr. Ola, for that very concise and very straight to the point presentation. I really learned a whole lot. So, guys, Dr. Ola has spoken to us for the last 36 to 37 minutes. So, please get your questions. I know you've gotten a lot of value, so please get your questions ready. But while we're waiting for the questions to come in, honestly, Doctor, when you were making your presentation, one thing really stood out for me, and starting from when you talked about the sort of correlation between traditional based investment and investing into startups. So that's sort of indirect relationship. So now with all that has happened within the fixed income space, right, there have been some sort of projection that we may go into recession in the coming years, right? So what are your thoughts around how people can position their investment portfolio in terms of the allocation towards startup-based investment to take position when whatever it is that is going to happen to fixed income-based investment is going to happen?
Absolutely, that's a great question. So I think, one of the points I tried to make over and over again was this point about diversification. And the most protective thing that you can do for yourself is to diversify your portfolio. So I'm sure we've all heard people say, I lost all my money on the stock market, or I lost all my money in real estate, and it's so sad. But these people shouldn't have had all of their money in real estate. They shouldn't have had all of their money in the stock market anyway. So this point around building a portfolio, and I have a much longer video that I just posted on portfolio management, value at risk, Markowitz, etc. So if you want to actually really take a deep dive into it, there's a great video on my YouTube about portfolio investing. I've just posted it. And I'll also post a longer video about VC and startup investing as well. I mean, I spoke for 30 minutes. The course that I have on YouTube is close to 5 hours. So if you're really interested in startup investing, then I'll post that as well towards the end of the webinar. But the best way to protect yourself apart from diversification is to understand what is protective and what is defensive against recessions, and try and recession-proof your portfolio. And one of the things I also said in the webinar is that startup investing does provide some protection against recessions, in that a lot of startups actually grow during recession. So when you think about Airbnb, when you think about Uber, when you think about, my Dell laptop, all of those companies were actually started during economic downturns. And actually there's a correlation between high performing startups and economic downturns, because a lot of the evidence shows that when a startup is created during an economic downturn, then they learn a lot of discipline. They have really tight processes. So they really start to perform when the market turns up, as it inevitably does.
Awesome. Thank you very much, Dr. La. So your responses even creates a very good transition into one of the questions questions that somebody just asked in the chat box. When we're talking about creating startups during economic downturns, you talked about discipline in the founders and how they are more concentrated on the problem they want to solve. So somebody just asked now that what are the most important elements of a potential investment? Like if you want to invest into a startup, what are the most important elements you want to consider? So the person is saying, is it the character of the company, of the founders? Is it their past progress, or in terms of other business ventures they've set up before? And in terms of, is it the traction of the business as of date? So more like, what are those key aspects when you are doing your due diligence on startups?
Okay, so I'll talk about what we do as a fund and the work we do in making sure that we're getting the right startups and investing in the right startups. So I think the key, first of all, is to have really good deal flow. So the more deals that you see, the more you'll be able to pick the great deals. And if you're not seeing enough deals, then, sorry, I'm just going to drink some water. If you're not seeing enough deals, then the chances are that you probably will not invest in the best deals. So every quarter, we see between 100 and 1,000 deals, which means we know what a good deal looks like when we see it, and we know what a bad deal looks like. So having great deal flow is important, and deal flow comes from reputation. As you know, I have almost 1 million followers on LinkedIn, which brings huge deal flow. I also have probably just over 200,000 on Twitter. So reach and reputation. Number two is being specialized in a particular area also brings deal flow. So a lot of venture capital firms that are generalist firms will refer to HealthCap when they want to do a fintech deal or when they want to do a health tech deal. They will say, look, Ola, can you have a look at this health tech? You're the doctor, you're the person who has sorts of investors that are doctors as well. You're the subject matter expert. We don't want another Theranos on our hands. Have a look at it and see what you think. You have team members that can interpret randomized control trials. We don't know how to do that. We've never worked in a hospital. Do you think doctors will like this? Do you think that, so having some area of expertise also helps. And that's why if you look at all the evidence again, specialist funds generally outperform generalist funds simply because, that subject matter expertise does give you some competitive advantage. So if you're in the banking industry and you're investing in fintechs, then that's great. If you're in the energy industry and you're investing in climate tech, that's great as well. If you're a logistics company or you're a logistics person and you're investing in logistics companies, that expertise does give you some kind of competitive advantage. But from a portfolio management point of view, you need to be careful, because if you're investing in ExxonMobil, if you work at ExxonMobil or Chevron and your entire portfolio is also invested in oil and gas stocks, when your job is on the line or when your salary is being cut, your personal portfolio will also be doing poorly because the oil price is down, right? So when the entire industry is down, you yourself will be down in your professional life, because obviously you work in the oil and gas industry and the oil price has gone down to $10. But also all your personal investments will go down at the same time. So thinking about diversification and thinking about protecting yourself sometimes means actually investing outside your core area of expertise, particularly if you're in a cyclical industry like mining, like oil and gas, when one day the price is 100 and the next day the price is 10, and they're sacking people and they're making all these sort of cuts across the industry in terms of salaries. You don't want your salary being cut or your job being at risk, and also your personal portfolio in perhaps public equities also, in a similar state. So if you're in oil and gas or if you're in a cyclical industry, you see the Qataris, the Saudis, etc. They invest heavily into healthcare because they know they're in the cyclical industry. And they also know that healthcare is a counter-cyclical and defensive stock or sector. So if you go to Qatar, if you speak to the people in Saudi, then they invest heavily into things that are counter-cyclical. So when their oil price is down and their revenues from their core source of business are down, they have something that is making money from them. And this is part of the diversification strategy that I've been speaking about from the beginning. Just being able to understand your portfolio and understand what you should be investing in and how you should diversify your investments. So, sorry, I've gone off on a tangent, but sort of deal sourcing and finding the right deals is important. understanding your personal circumstances within your industry and where your salary is coming from, your base salary is coming from, is really important, and making sure that you diversify against that. Understanding your skill set as well. If you're sort of somebody that likes working with entrepreneurs and can be very successful working with entrepreneurs, somebody that wants to perhaps, explore entrepreneurship in a safe way. So I never like the most successful entrepreneurs in Nigeria are people that didn't quit their jobs. If you think about Eigen Herbert from Access Bank, they stayed at GTB till the last minute. If you think about Wenger from Flutterwave, he didn't leave Access Bank till very, very late in his journey. So I think that, understanding, that there are ways to explore entrepreneurship and be entrepreneurial while keeping the safety and, being able to pay your children's school fees. But you can bring your expertise into startups and get that kind of entrepreneurial upside as well with a stable form of income. So through angel investing, you can get an entrepreneurial upside by investing and taking a large ownership stake in those companies. You can still get the kind of upside that you get as an entrepreneur without quitting your job. So just understanding where your skill sets lie and what you want to do is important. And then being able to have a really thorough process of background checks. Checking the background of the founder, checking the background of the team members, speaking to customers, speaking to other investors, going to CAC, making sure they're properly registered, due diligence on the actual technology as well. So understanding, if this is original code or if the company is using sort of white labeled products and why they're doing it. Looking at the actual product and understanding the UX of that product, understanding the market as well, and understanding the companies in that industry that have sort of grown. If you don't have any examples within Africa, you can look to Asia, you can look to South America to see sort of comparable companies and how they've grown and how they've exited, if they've IPO'd, what kind of revenues they were doing, and really feeding all of that into your investment decision. But like I said, you have to do it lots and lots of times. Don't do the first deal that comes to your desk unless it's been diligenced by a syndicate. You have to look at lots and lots of deals and then be able to find out, which one is a good deal for you and your skill set and your industry.
Right, thank you very much, Dr. La. Very, very spot on, right? Your ability to look at different deals that coming through a wide deal flow tends to improve on your skill set in knowing what sort of things you should be looking out for in startups. Very, very, very important. So whilst we were just talking about all the different things here that you want to look at into a startup, I believe some HNIs in the house will be like, oh my God, that is a lot, right? So now from an efficiency perspective and also from a returns and performance perspective, right, would you say it is better for people to, let's say, try their hands out in investing into startups by maybe investing into a fund that has that track record and that expertise in looking at this deal, as opposed to equipping themselves to be able to do the due diligence themselves and eventually invest? Some people will be like, I want to see where my money is going, so I want to know what my money is going to come, what will come out of my money, right? So from an efficiency perspective and also a returns perspective, how would you evaluate these two approaches to investing into startups?
So I think if you have a lot of time and if you have sort of great deal flow, there are people called super angels that are able to do the investments by themselves. But, it is quite time consuming and, you don't want to make a wrong decision. So if you do have the time on your hands, you do have the bandwidth, perhaps you might be able to employ somebody full time to assess and do some of the financial modeling work for you, etc. Then that might be a way to go for the ultra high net worths. But I think for most people, for the ultra high net worths, it's very difficult because they just don't deploy small amounts of money. It's very difficult for them to deploy, money into startups. So they tend to invest in funds more. But for HNIs, sort of on a sort of beginning to mid-range, I would say, they may want to employ somebody to do that and to manage their deal flow. But I think it's very, very difficult to get the appropriate number of deals. Like I said, a formal fund would probably see between 100 and 1,000 deals per quarter, 4,000 deals per year. And it's really difficult for an individual person to see that many deals. And even if you're seeing that many deals, it's very difficult for you to do due diligence on all of those deals, which includes, of course, like I said, checking out the product, checking out the UX, checking out the code, speaking to customers, speaking to former investors, speaking to other employees, speaking to current employees, speaking to ex-employees, and then doing the full market analysis, the financial model, understanding the projections, understanding the comparator companies, understanding how this company would exit or list. And then after the investment, obviously doing all the post-investment management with them, which means fortnightly checking calls, strategy meetings, business development, marketing, support, recruiting talent, etc. So it really is a personal preference. I wouldn't say one is better than the other, but I would say that definitely one is more time consuming and resource consuming than the other.
All right, thank you very much for that wonderful response, Doctor. So somebody is asking in the chat box, and because of time, I think this will be the last question that we are going to be taking, right? And the person says that there are so many other competitor funds out there in the African space, right? And the person cited a number of others. Now, the person is asking how different is HealthCap from the rest of these other funds. So do you want to talk about that?
So this isn't sort of an advert for HealthCap. It's more sort of talking in general about the approach that you should have to investment. So it's about education more than anything. But in terms of, I guess what makes HealthCap different, and I think what I should answer is how to go about assessing a fund that you would want to invest in as a HNI or as a family office. So I think the first thing that you should consider is track record. So I introduced 3 terms in this tutorial: IRR, DPI, and TVPI. So look at the IRR. How much did their last fund do in terms of returns? Look at the DPI particularly. How much actual cash did they return to investors? And then look at the TVPI as well. What's remaining in the fund with the remaining assets over the fund life, and what could they potentially return to investors if these companies were to IPO or to be acquired. So track record is number 1. Number 2, I think, is looking at the GP and the team. So GP is very key. What is the skill set of the GP? A lot of people tend to fall for good salespeople as opposed to good investors. So really, does the GP and the team have the financial skill set, the investment skill set, the portfolio management skill set to really construct a portfolio that's going to deliver returns? I think that's super important. So don't be afraid to ask for people's qualifications. Don't be afraid to ask for the team members' qualifications as well, how many deals that they're seeing, etc. I think that's super important as well. Number 3, what a founder's saying about them. If founders hate them and they're always like very nasty to founders, then they'll begin to develop a reputation, and no founders will approach them for investment, and they'll lose deal flow. So it's really important to also understand what their reputation is in the industry, particularly with founders. If you can get founder testimonials, that's great. How do they treat their LPs? How do they treat their investors? So speak to people that have invested with them before and see actually how much information investors are willing to get, the quality of updates, the quality of annual general meetings, for instance, that investors are invited to. I think that's super important. So a fund that treats its investors with respect. And I think the third thing is specialization. Every article you will read on specialist versus generalist funds say that if you have a sector specialization, then you're likely to outperform a more generalist fund. People always say invest in what you know. So I think it's an important consideration to think about what does this fund focus on, and how does how am I aligned with this thesis? So I think that those are the most important things. There might be other things, Miracle, if you thought of anything else that I missed. But I think that those are the most important things when you're considering a fund to invest in, because you're right, it's a competitive environment. Some figures that I've read say that there's like 3,000 funds across the world in the market. So how do you choose between them. And I think it's number one, track record. Number two, there's team skills and the GP skills. What other LPs saying about the fund? How do they treat their investors? How do they treat their founders? And do they have some kind of specialist skill? What's their source of competitive advantage? What's competitive about their deal flow? What makes them get better deal flow than anybody else? What kind of portfolio management do they do? And how do they outperform in the area of looking after the companies and adding value to the companies that they've invested in?
Yeah, thank you very much, Dr. La. That's a very concise and robust summary of everything that one should be able to look at. And if I'm to even just buttress on any part, it would be how important it is, the value add to the startup is, right? Because in the end, the sort of support you provide to the startups tend to determine whether they are going to succeed or not to succeed. So thank you very much, Doctor, for that wonderful presentation, and also for responding to all the different questions that came on this particular webinar. So really sorry that we couldn't take all the different questions, because we try to be disciplined and we just want to keep it for just an hour. But definitely, you're going to be getting the recording of this particular webinar, so that you can always go back to it at the end of the day, right? And also, I see a lot of questions around the FDHIC Catalyst Fund. How do I become a member? And what is the minimum investment amount? What are the different terms for the fund? So I've posted a link in the chat box. So for institutional-based investors and also for individuals, you see the link just for you to register your interest, and definitely somebody from the team is going to be in touch with you to guide you on the next step. So thank you very much again for coming on this webinar. Thank you so much, Dr. Ola. I know it's a very busy period for you, but you still made out time to help us share in your knowledge. So thank you very much, much appreciated. And for everyone that came on board this call, we are so grateful. We expect to hear more from you. We want to see those engagements more. So in case you want to send us an email, you can send us an email, investor.relations@healthcap.co. We also want to reach us on all our social media handles. So thank you very much for coming on this webinar, and I hope you got value. Thank you very much. Bye.